A deeper dive into off-market data revealed some interesting findings this week, and true impact of 7% interest rates are starting to reveal themselves. So the question is, has it hurt the market? That's what we're covering and more in this week's report. As always, thanks for taking a few minutes to join us for our weekly look at real-time market insights into our local housing market. My name is Scott Parker. I'm the Vice President of Sales and Marketing here at John Green Realtor, and I'll be presenting this week's findings. So let's get into it. New listings for the four counties we track. And as we mentioned last week, new listings usually peak this time of year and start to slowly decline as we get into the dog days of summer. It looks like we'll peak out around that 1,100 new listings per week mark, but way below where we were these past few years. Here's under contract activity, which typically peaks out earlier around late April and May in any given year. And with strong demand relative to current inventory levels, this number will go as new listing activity goes. So unless we see some major pop in any given week in new homes to sell, there are simply only so many homes that can go under contract. So that trend should continue. Here's showing activity, and you can see it's now on the typical seasonal decline, but for now, all indications are we are going to have a stronger demand in the second half of this year versus last year. Of course, a lot of things can certainly change that, but all of the big macros that we're watching tend to indicate that this should be a good second half of the year, stronger than potentially even last year. So let's go into off-market activity, like I talked about in the opener. So these are the listings that either canceled or expired. So they left the market without finding a buyer, and we saw a slight dip again this week. But we thought we'd pull back the curtain here because this is kind of proof that you can make data look however you want. Here's off-market activity relative to new listings. So while the number of off-market homes from the last graph is still low in comparison to the last couple of years, the reality is that relative to new listing activity until this week, it was actually a bit higher than the previous 2 years. And here's further proof that you can make data look however you want. This is a different look where we bring 2019, kind of those pre-COVID numbers into play. And here you can see the impact. So when inventory is tight and demand is strong, you end up with very low off-market activity relative to the overall inventory, where you can see in 2019, off-market activity was much more robust. So let's go into some of our supply, balance metrics. And so 60% on this graph is considered pretty normal, kind of steadying now in that range right above that. So not terribly out of balance, but certainly undersupplied as we head towards the end of June here. And here we add in off-market activity, and you can see the same kind of impact. We're going to take a look at inventory nationally here for a second. And what we want to point out here is just how this year's trend matches the shape of 2021 and the pre-COVID, but not necessarily last year. So last year, we had this sharp increase in supply in June. And our friends at Altos Research provided this graph, and maybe a really good point when comparing this year to last year, in that it appears that it's not necessarily high interest rates that cause a market to shift. It's more so quickly changing interest rates, because that's really what we saw. We saw it in June of last year, and we kind of everything stabilized in July and August. Then we kind of saw it again in September and October. And that's exactly what we were seeing at this time last year, was that real sharp, steep rise in interest rates. So buyers started to pause, and it pushed a lot of sellers to kind of quickly list and shift some of that supply forward a bit before they quote unquote miss the market. So interest rates have remained fairly steady with only small fluctuations this year. And you can see now this being reflected in the data that it really hasn't moved the needle on demand and willing buyers all that much. So big learnings from this week. It's a quick change in rates, not necessarily the height of rates that has the big impact on the market. And off-market activity deep dive kind of revealed that our current market is still so far removed from the more normalized pre-COVID market. This higher rate, low inventory market is probably just our new normal for this foreseeable future. Thanks for joining us, and we'll see you again here next week.